Hi, I'm Doug Carroll from InsidersGuideToFinance.com with the second of a series of videos on interpreting yield to maturity as a measure of market value, or alternatively, as a quantification of the cost of the future contractual cash flows on a bond. In the first video of the series, I focused on trying to explain how yield to maturity could be interpreted as an expression of value or cost of future cash flows. But I looked at it in the context of a single cash flow investment security because I wanted to describe this interpretation of yield in the simplest context possible. But the real power of understanding yield as an expression of value is in the context of comparing different bonds to one another. Because if we're trying to understand different bonds in terms of the cost today per dollar of future cash flow, when could you get that insight? When could you understand the cost today per dollar of future cash flow by comparing the prices of different bonds to one another? Well, the only time dollar or percent of par prices would give you a direct insight on the relative cost of different bonds in that sense of what you're paying today per dollar of future cash flow is if all the bonds you are comparing had the same coupon rate, the same time to maturity, the same embedded optionality, the same credit risk, and on and on and on. In fact, the only thing that could differ about the two bonds is they could be from different issuers. But in all other regards of contract terms and relative risk, the bonds would have to be exactly the same. How often when one is comparing a range of different investment opportunities in the fixed income market, does every one of the bonds you're comparing have same coupon, same maturity, same embedded optionality, etc., etc., etc.? Never. Which means you can never understand the relative cost per dollar of future cash flow on different securities by doing a comparison of their market prices, whether expressed in a dollar cents or percent of par cents. So let's move the discussion of understanding yield as a measure of cost of future cash flows or market value into the context of comparing two different bonds to one another. Now, again, this is going to be a simplified example. We'll amp it up to more complicated situations in subsequent videos. But let's say we're comparing two extremely similar bonds, in fact, bonds that are similar in all ways relative to one another, except they have different coupon rates. So let's say we have two bonds whose relative value we want to assess. A bond A and a bond B, if you will. So we'll say both bonds have exactly 3 years to maturity, and the two bonds have exactly the same credit risk. Now that could mean they're either from the same issuer, or alternatively they're from different issuers, but you believe those issuers represent exactly the same credit risk relative to one another. Now note, that does not necessarily mean they have the same credit rating, because you could have two bonds with exactly the same credit rating, say two bonds that were both single A rated. But if you thought one of those bonds was a candidate for a credit rating upgrade and the other a candidate for a credit rating downgrade, that would mean that despite the fact they had the same credit rating, you wouldn't believe they represented the same credit risk. And I'm saying no, these two bonds have exactly the same credit risk. So imagine they're both treasury securities that have exactly 3 years to maturity. Or both bonds that are from JP Morgan Chase that have exactly the same 3 years to maturity. So we've got two bonds with the same credit risk and the same time to maturity, but they have different coupon rates. One is a 5% coupon bond, the other a 9% coupon bond. And we're also showing the price of the two bonds. The 5% coupon bond trading at $972 and some cents. The 9% coupon bond trading at $1,081 and some cents. And in both cases, we're assuming this is per $1,000 par value. And my question to you is, which of those two bonds is cheaper? And I mean cheaper in the sense that that term would typically be employed by two bond traders talking to one another, or a bond portfolio manager and analyst talking to one another when they're discussing the relative attractiveness of different securities. And I guarantee you, in such contexts where the relative investment merits are being discussed, cheap would not mean that 972 is less than 1081, nor would cheap mean 972 is a discount to par. And similarly, in such a conversation, rich would not mean 1081 is more than 972, or 1081 is a premium to par. So if when bond traders or bond portfolio managers or analysts are talking to one another and they're discussing about whether a bond is rich or cheap, they're not talking about the relative market price of one bond versus another, or the market price relative to a bond's par value. Well, if that's not what rich or cheap is an allusion to, rich or cheap relative to what? Well, the phraseology can be used in a number of different contexts, but cheap would normally mean that when I'm comparing two bonds to one another, the bond I'm recognizing as cheap, I'm paying less today per dollar of future contractual cash flow to maturity. Or alternatively, I might designate a bond cheap because I think it has a lower cost today per dollar of future cash flow than some measure of fair value. Conversely, rich would mean, in the context of a comparison between two bonds, that the bond I'm recognizing as rich has a higher cost today per dollar of future cash flow than the bond I'm comparing it to. Or alternatively, rich could mean that the bond I'm so designating has a higher cost today per dollar of future cash flow than some measure of fair value. So let's go back to our comparison between bond A and bond B. Which is cheap, or for that matter, which is rich relative to one another? Well, note, since the bonds are not exactly the same, despite the fact that they have the same credit risk and the same time to maturity, the mere fact that they have different coupon rates means that I cannot discern which of those is relatively rich or relatively cheap by a simple comparison of the dollar prices of the two bonds. Because clearly bond A has a lower dollar price, $9.72 in some sense, but that bond A also gives me lower cash flow, $50 a year since it has a 5% coupon, versus bond B, which has a 9% coupon, which gives its holder $90 a year. So if I'm trying to understand which is the better deal, in other words, which bond I'm paying less today per dollar of future cash flow, how do I get that? That's what yield to maturity tells you. So by plugging in the contractual cash flows and the dollar prices and then solving for the yield to maturity doesn't tell me my future rates of return. I can't know the reinvestment return I'll earn on all the cash flows I received prior to maturity. What yield to maturity does is re-expresses the price as a single interest rate, and that single interest rate is a representation of the relative cost today per dollar of future contractual cash flow. So what happens if we plug the contractual cash flows and the prices for both bond A and B into the price yield formula? Well, in a sense, I started the example out with an unfair question. Because you'll note if we calculate the yields on the two bonds, it turns out both bonds, given those market prices, are trading at exactly a 6% yield to maturity. In other words, the two bonds have exactly the same relative cost per dollar of future cash flow. Because if they had different yields, the bond with a lower yield would imply a higher cost today per dollar of future cash flow, or a bond at a higher yield would imply a lower cost today per dollar of future cash flow. But the same yield on the two bonds means they have the same relative cost today per dollar of future cash flow. Does that mean I would find the two bonds exactly equal in terms of their relative attractiveness? Not necessarily. Now, again, if I discern some slight difference in credit risk, or maybe a large prospective difference in credit risk, if the two bonds have the same cost today per dollar of future cash flow, then the one that I perceived as being a better credit risk might be the more attractive security. But that wouldn't be the only basis for recognizing some difference between the two. What happens if I believe that interest rates were likely to rise in the foreseeable future? That might cause me to perceive bond B as relatively more attractive because it would give me more money to reinvest at those higher anticipated interest rates. Well, much more needs to be said about yield as a measure of relative cost and, for that matter, relative risk. Because one point that is important to make about the preceding example was the great similarity between the two securities. Same credit risk and same lack of embedded optionality. And I didn't even bring into the discussion potential differences in liquidity risk. So in the vast majority of cases, the bonds, even if they had the same time to maturity, would likely differ at least slightly, if not in a very large way, in terms of those factors, like differences in credit risk, differences in liquidity, differences in embedded optionality. So in the vast majority of instances, when I'm comparing two different securities, the difference in yields will not only reflect cost of future cash flows in some general abstract sense, but will also be a reflection of the market's pricing of the differences in those risks of one security versus the other. So normally a comparison of the relative value of two bonds, and this is why I earlier said yield is a measure of relative value and relative risk. Yield spreads between two bonds will need to be risk adjusted. That is, in some way, shape, or form, try to account for differences in credit risk or differences in embedded optionality. But those will be subjects of later videos in this series. I hope you enjoyed this video. You can go to our YouTube channel or Facebook page to see other videos on a range of investment-related topics. Or you can go to the website, insidersguidetofinance.com. At our website, in addition to the free video shorts, there are a series of modestly priced, in-depth training videos with running times of approximately 1 hour each that go into a number of subjects in greater detail. The website and Facebook page also contain information about open enrollment programs I will be presenting over the next few months and my recently released book, The Insider's Guide to Fixed Income Securities and Markets.